All these online gurus lead you to believe that investing is a quick and easy, sure way to make money on the side. Well, I'm here to tell you that's just not the truth. What is up, everyone? Welcome back to the E-Money channel. My name is E-Money. I'm a 20-year-old crypto investor, stock option trader, and entrepreneur. And today I'm going to be talking to you guys about 5 things that I just wish I knew ahead of time when I started investing. Knowing this information ahead of time could have saved me thousands and thousands of dollars in the long run, and I'm giving this information to you guys completely free, as well as a bonus tip if you guys make it to the end of the video. The first thing you need to do is be honest with yourself and set clear financial goals, and you can do this by clicking the like button, subscribing, and turning on post notification bells, because 81% of you guys watch these videos consistently and aren't even subscribed to the channel. But in all seriousness, you guys have to be honest with yourself and figure out what this money is for. Are you preparing yourself for retirement? Are you saving for education? Are you saving to purchase a house? These things are all very important, and it's going to affect how aggressively you invest your funds. The second thing that you need to understand before you invest is understanding that you have a risk tolerance and you need to find out what it is. Now, this is going to differ from person to person and based off of your income or how much you value money. For some, $1,000 may not be a lot, and for some, $1,000 is all they have to spare for investments. If you're on the lower end of the spectrum and $1,000 is a lot of money for you, it may be a better idea to kind of diversify it into different things rather than putting that $1,000 into one stock. In addition, people with low risk tolerance are more likely to put their investments into things like ETFs and bonds rather than people who are more aggressively investing into things like tech stock. There's really no one size fits all when it comes to investing. The third thing that I wish I knew before I started investing is that there are costs and fees associated with investing and trading your money. The 2 most common are brokerage fees and capital gains tax. Simply put, what a brokerage is basically an entity that provides a transaction between you and the markets, so the brokerage will buy and sell assets on your behalf. This is a service, and in all service-based economies, there is a fee associated with this process. 2 brokerages that I love using are Robinhood and Webull. Webull is actually my personal favorite. Robinhood is a good and simplistic alternative as well. I just don't like the fees associated with it, and you also don't always get the best price when you're buying into the market. Robinhood, also compared to Webull, charges more on transaction fees, so that's why I prefer to use Webull, because the cost of trading on there is just way lower. Now, on the downside, Webull is also a little bit more advanced, so for someone just getting into investing and trading, it is probably not the best option. For those of you interested in getting started with investing, I've left links to both Robinhood and Webull down below. If you guys sign up, they have promotions going on where you can get free stocks if you sign up and link your bank account. The fourth thing I wish I did before I started investing was educate myself and not just blindly trust the things that other people say about things that I should be investing in. Especially on social media, it can be very easy to get caught in the advertisement trap where these creators and gurus talk about how this next stock is going to go up 1,000 or 100,000%. It's very important that you guys go out and do your own fundamental research. You need to look at things like, is this stock performing well in its market compared to its competitors? How long has this stock been around and how has it performed through recessions? As well as looking at their revenue and seeing if they're the ones leading innovation in their industries. Having a deep understanding of these things will lead you to make more intelligent and less emotional choices when you're investing. People who win in the market are those who are confident and sure in their positions, and they hold them long term. It is easy to get shaken out of your position and lose money if you're not confident. You guys need to understand that the market moves in 3 ways. Either it moves sideways, it moves up, or it moves down. But over the long term, the stock market yields an annual percentage of about 10% per each year. People actually lose the most money when they make emotional decisions based off of headlines in the news. You have to understand that these news and media outlets are companies, and companies are designed to make money. When they're creating headlines about this stock is about to fall or it hasn't performed as well as it should have, they're most likely having their partners in the background buy these assets and these stocks while you're selling and panicking. This is exactly what the phrase buy the hype, sell the news means. The 5th thing I wish I knew before I started investing is actually that the time horizon of when you invest matters. This basically means that the longer you're invested into an asset, the less that the fluctuations in the price in the short term will affect you. For example, say you got into Tesla when it was around $50, and now Tesla's around $100, then it comes back down to around $70. Well, since you bought at $50, you're still in profit, so that drop to $75 may not affect you as much as someone who bought at $100 and now they're down $25 per stock. This comes full circle with risk tolerance. The longer you've been in the market, the more likely you're able to tolerate fluctuations in the short term. Alright, that is going to lead us straight into our bonus tip. I want to thank you guys for making it this far in the video. If you haven't already, please make sure you like, subscribe, and turn on those post notifications. The bonus tip is going to be to regularly rebalance your portfolio. Markets are constantly evolving and changing, and you need to evolve and change your portfolio to go with it. We go through periods like now where there are recessions, where you need to be investing more heavily, because when we do things like recover, which is where we're leading into, you'll be making more money earlier than everybody else who buys into the market. And most investors and most people who hop into the markets off of news actually end up buying at the top and losing money. That being said, I want to make it completely clear that these portfolios for investing are not your emergency funds. The worst thing you can do as an investor is to be put in a situation where you have to take out of your assets and out of your stocks and convert it into regular cash to pay for things that you need. Only invest what you can afford. People who don't form emotional attachments with the monies that they have in the markets, and when the price fluctuates, they're quick to sell, even if it's for a loss. That about sums it up for today's video. If you guys are interested in learning what you can invest in for long-term wealth, or how to form an LLC, or also how to stop living from paycheck to paycheck, there are other videos on the eMoney channel that you guys can go ahead and check out. Please do me a favor, like, subscribe, turn on those post notifications, and I'll see you guys in the next one. Peace.